Good day, investors. Today we are taking a look at one of the best risk-reward and cheapest energy plays out there, Harbour Energy. We're gonna look at their first half results and revisit our thesis. So we're gonna look at their operations, financials, and most importantly, update the valuation for the stock. That said, if you want to dive deeper or just want to support the channel, feel free to check out my YouTube membership where I post weekly. And with the boardroom tier, you can get access to my Discord channel where we can have direct discussions. Stock is up only 23% here today. Why is that? Well, you have BASF, the largest shareholder, the German chemical giant, selling its stake down from roughly 40% below 25 already because it's a non-strategic investment for them and they want to divest. This is legacy 24 post acquisition, their stake. So you have a motivated seller despite fundamentals. So that's good. Dividends should be around 6%, not what this says. We'll discuss that. We're going to look at the London listed shares, but every financial number is going to be in US dollars, not pounds, but I'll make the distinctions for you. Now, here what you can see is that the first half was extremely robust, more than 500,000 barrels a day production, 1.8 billion free cash flow, on a market cap in dollar terms around 5.2, so that's like a 34%-ish free cash flow yield already. Very robust dividend and buyback, but we'll discuss all of this. And then you can see that past production was mainly driven by acquisitions. And the company is now shifting production to lower cost, lower tax bases with significant running room. And tax is a major story for this company because they do operate in Norway and in the UK. Now, Harbour basically has these 5 areas, roughly more than 90% of their production, and some stuff in Southeast Asia. Let's start with Norway. So, largest production engine with high quality assets, strong reliability, and significant near field opportunities. The UK, large, mature, declining story. They focus on cash generation there, not necessarily much reinvestment. These both are high tax regions, but at least you get European gas pricing. Argentina, long life, predominantly gas, as you'll see, with both conventional and unconventional resources offering meaningful long-term growth. We'll see how Argentina turns out. So that's a big bet on Argentina. US growth, heavily oil weighted. So that's something you want to see from the US. Offshore growth, oil focused. You don't want to get really North American gas pricing. And if you think about Mexico, it's again large offshore oil discoveries for potential future growth. Because if you look at the production profile expected to be in 2026, you see that Norway, the UK are the big legs. You have Argentina, you have the US, some with Mexico, but that's really future, and then other Southeast Asia and the like. Pricing wise, you have basically other gas 20, European gas and liquids 40-40. So that's a really tempting price realization. Why is that? Now, let's start with the bottom left. You see that gas is 60% of their mix, liquids are 40%. But if you think about pricing, gas is not created equal. So 40% of total pricing is coming from European gas, 40% from liquids, and 20% from other gas. So that is a story that you want to see. You want to get much of that juicy European and liquids production. So this is basically production pricing, so prod pricing. So that means basically other gas is not contributing much to their earnings. It's driven by liquids and gas, but we'll take a look at that. And as I said, Norway and the UK are the major drivers on both gas and liquids. Good story on the liquids part, as discussed, offshore US and some Mexico, some Argentina, but Argentina is really a big component from the gas perspective, which is not as cool because if you think about other gas, you mainly think about Argentina, and other gas is 3.6 versus European gas for the same amount, 14.4. So crude post-hedging was realized at 84. If I would do the math for this would be like roughly 86. So we are getting oil equivalent pricing on the European gas market. That's what you want to get. If I would annualize, barrels of oil equivalent, transform this would be like 22 or something. So this is pretty bad. You don't want to get other gas. Other gas is sad. These other guys are happy. So I'm a happy guy if I see these two, and I'm sad if I see other gas. So that's how you should think about their profitability of the business. Now, one item I would like to highlight is their equity structure. So if you just open up this, you look at the balance sheet, you see that, hey, Peter, like 1/3 of the business is owned by somebody else. not that fast, because Harbour's equity base looks unusual because of this 2 billion perpetual subordinated hybrid bonds, inherited largely through the Wintershall DE acquisition. They are legally debt-like instruments, but classified as equity under IFRS accounting because they have no mandatory repayment and coupons can be deferred. They rank ahead of shareholder ordinary shares. But how much do they take from my pie? It's not going to be 1/3. If you are the owner here, they took from the profits. This is like roughly 11%, and this is 89%. But you shouldn't just assume that, okay, like then I take a 10% haircut and goodbye. No, you have to look at the hybrid bonds, and you see you have basically two types. You have the 3% and a 6% bond, and then they are paying this much. So roughly, let's call it 100 million a year is coming down from your cash flow to pay your bondholders. Simple as that. So when you're looking at the company's equity, and when I'm doing my math on the debt to equity, I'm actually doing it with this, while I should be doing with this. So I'm understating their indebtedness, but even that way they have much higher debt than I think, because I'm using the 6.6 as their equity, but actually their equity is 4.6, right? You get the story. Now, with that, you see debt is really high, actually higher, because you have those hybrid bonds. Interest coverage is rather weak at 5.4 times, and you have more debt which sharply increased following the 3.2 billion LLOG acquisition, including the 2.7 of cash consideration, temporarily raising leverage before subsequent free cash flow driven deleveraging. So that's the story. You did a lot of M&As. Now you have the cash. Now you delever. Now, Harbour's transformation has been heavily driven by M&A. In the top, you will see free cash flow, dividends, and shares outstanding. With the Wintershall and the LLOG deals dramatically expanding the business, but also driving significant debt and equity issuance. So shares outstanding have risen roughly 170% since 2023, or I compare it to 2020, but it's the same. So since 23, but this dilution funded a much larger and more diversified asset base, while free cash flow has recovered strongly following the acquisition period. And here you can pause the video and take a look at the past of these deals. Now, was that value additive? So on the top, you see since 2019 through 25, you had reserve growth close to 30% and production growth annually. So this is compounded annual, 22%. So massive growth. But if I adjust for the shares, then yes, reserves are up 9% annually and 3% on the production front when I adjust for the dilution. So this was a good move overall. Of course, we also have to consider the debt, but they should be able to pay it off. If you think about, I jump back here, this is their debt, 6.8, their free cash flow in the first half, and actually that is going to be their full year free cash flow. We're going to talk about that. That is like 3.8 times the debt. So it's a lot of leverage. Even with strong free cash flow, it would take them 4 years to pay it off. Now, back to here. This is their guidance. So this was the outlook in 2026 March, was 600 million free cash flow, and call it a day. Then their outlook increased to 1.4, and now the outlook is at 1.8 billion full year. Now, they give us some sensitivity, so it makes my life easier to really model this story. And actually, if you pause and look at the assumptions that go into these prices, then you will see that for this to happen, for the 1.8 billion, they are assuming 85 Brent and 15 European gas. So that's how you should think about this. When I'm doing my modeling, I have my own bear and base and bull case scenarios, and I adjust for these sensitivities. Now, okay, 45 to 75% of free cash flow will be given to the shareholders. How are they gonna do it? First, they have the base dividend at 300 million. So 300, wait, where should I write? So 300 million divided by the market cap of like 5.2 is roughly like 5.8% or 9%, something like that. So they have a decent dividend yield, and on top of that, they are expecting to do additional returns, possibly buybacks. Now, shareholder authority to buy back shares directly from BASF. As I mentioned, BASF became Harbour's largest shareholder through the 2024 Wintershall acquisition, initially owning as much as 40% stake, which was never considered strategic, and BASF is progressively selling it down as part of its planned exit. Mid-May, it fell below 25% from 40. So the stock is up like 20%, 23% year to date, with BASF actively selling like 20% of the business. So that is remarkable. Actually, it keeps the share price lower for everybody else to buy if you consider it to be a good deal. And what I wanted to highlight is that, wait a second, Peter, the first half was already 1.8 billion. So why do they say the full year is going to be 1.8 billion? Well, we'll talk about that on the next slide. So, and the next slide is, well, taxes and capex. So they're gonna have, in the first half, they spent 1 billion capex. Now they're gonna spend 1.3. So there is 300 million gone. And then in the first half, they paid 1.5, and now they're gonna pay 2.4 in taxes. So basically, you have way more going out of the window. That is basically cutting their capex, their free cash flows to where they are in the first half on average. So the full year is going to be like the first half on a free cash flow basis. It is going to be 1.8 billion full year, not just the first half, which is not a bad deal because that's already 34% free cash flow yield. And with that, if you look at their outlook for the future, the company is kind enough to give us some good numbers. So you can see where the growth is coming. You have some Norway, some UK, Argentina, US growth is really big going forward. Mexico is expected to be good, and then Asian part is getting cut. You have a capex for 26, and then beyond that, you also have a capex guidance. Same for production, which is expected to be a bit lower than 26 going onward, flat. So this is really good. I can use it as my model with the sensitivities. And with that, you have the three scenarios. So you have 65 Brent, 36.5 TTF gas, 80, 45, and 95, 53. So different levels of cumulative free cash flow. My base case is below the company's below the company's 1.8 billion guidance. So the company, if I put this on a scale like this, they're already here. So they are between the base and bull case, closer to the base case, because I'm expecting cumulative free cash flow to be 8.1. But if I would just, we are talking about 5 years. If I would look at the 1.8 billion in 26, 5 times that is 9 billion. So I'm 10% below that. Why? Because the company is using 85 Brent, I'm using 80 Brent, and the company is using 44.5 TTF. I'm using 45, a bit more there for my base case. Plus, I'm adjusting for the hybrid notes 100 million a year. So that's how I try to keep it conservative. On the share buybacks, actually on the valuation assumptions, I can mention first that 10% discount rate, 0 perpetual growth beyond 2030. And actually, what I do is that 2026, I do guidance, and 27 onwards, I do guidance again. But that guidance is lower capex and lower production. So I'm going to use that held flat. Now, I also adjust the free cash flow, as I said, for 100 million year payment on the hybrid notes. And the share buybacks are modeled after the 300 million base dividend paid, and trying to be a bit more conservative there, because of course, if the company would buy back, let's say 90% of the shares, then the share price would go up, and my model doesn't capture that. So I have 3 scenarios for you: 5%, 10%, and 20% shares outstanding reduction via buybacks. You have 3 implied share prices, upside of 14%, close to 200 and 400%. So yes, this is very robust, but you also have to keep in mind the company is massively in debt. They have many operational risks because their portfolios spread around the world. You have Norway, you have the UK, you have Southeast Asia still, you have Mexico, the US, and Argentina. So you're all everywhere. So that doesn't help your story. Now, to sum it all up, operationally, so robust production growth driven by M&A and strong execution with record more than 500,000 a day production in the first half. strong realized pricing with liquids and European gas representing majority of production exposure and driving earnings. And globally scattered operations, so that's why I have this at yellow. Increase complexity and risk. Growing US exposure also increases, not US, AG, because the US is liquids focused. So growing Argentine exposure increases exposure to lower price Argentine gas versus the European gas price. As you've seen, other gas was 3.6, while European gas was like 14.4 or something like that. So a fraction, a third of the price. Financials, high leverage, 6.8 debt, 100% debt to equity, with using 6 billion as my equity instead of 4, because there is 2 billion in hybrid notes, which are still counted as equity. So this debt to equity should be like 150%. So very highly levered company. 5.4 times interest coverage ratio is kind of weak for a cyclical player. Despite the strong prices in the first half. So it was actually lower before. It was like 2 point something times interest coverage. So basically barely paying its debt. And the debt is roughly 3.8 times the 26 guided free cash flow. So even if they just buy back the debt, they just pay down debt, that would cost them 4 years to do. And then keep in mind 6.8 debt with the market cap of 5.2. So they have more debt than the market cap. Higher commodity prices provide strong deleveraging potential. So this is what I'm talking about. Management still targets 45 to 75% of free cash flow for shareholder returns, including a 3 million base dividend and the 500 million additional returns, which are probably going to be buybacks. On the other hand, they could do debt reduction, but we'll see what they end up doing. And first half already generated 1.8 billion free cash flow, yet the guidance for the full year is also 1.8 due to higher taxes and capex in the second half. Valuation, what can I say? On paper, you cannot lose. Of course, you can lose if the company has operational risk, oil prices go down, then the price will go down anyway. Doesn't matter what the valuation is. And commodity prices just go down, hurt the business, balance sheet is poor. Now, the base free cash flow yield, with my math is like the base, I mean, my base case scenario is already close to 30%. If I just look at the company's guidance of 1.8 billion, that is 34% of free cash flow yield already. A dividend is 300 million. It's roughly 6% dividend yield with buybacks potentially at 500 million, although that can be like, this is called like additional returns in 26. So that can be even debt repayment. Now, overall, I would say weak balance sheet and scattered global operations justify a discount, but 5.2 billion market cap for a 500,000 barrel a day production looks pretty cheap. If Harbour can delever and continue buybacks in a stronger commodity price environment. So when does this story work? It works if oil and gas prices stay higher, a company doesn't have any operational disruptions, and they can deleverage. So if the first two happens, the company can work out well. If they don't happen, well, in theory, the bear case with 65 VTI is still enough to survive. Now, Harbour looks overall deeply undervalued on cash flow, but the upside depends, as said, heavily on deleveraging, making the 6.8 debt load the key risks to otherwise compelling valuation. And to do that, you need to have your operations running and you need to have good prices on your commodities. With that, you see in the table, Harbour is the cheapest name out there with a massive upside on the base case and the massive free cash flow yield. Let me know what you guys think. If you found this video helpful, please consider liking and subscribing, even checking out the membership if that's your thing. And let me know what you really think about the company. So thanks again, and I'll see you in the next one. Take care.